think we're live, potentially.
Good afternoon, everyone, and welcome to this Dunstan Thomas lunchtime webinar on the Consumer Duty. We'll begin with a few introductory remarks from myself as your chair today. I'm Adrian Boulding, I'm Director of Retirement Strategy here at Dunstan Thomas, and reflecting at the new Consumer Duty, it occurred to me that my career has been, peppered with a fair spread of scandals resulting in fines and compensation payments. I've worked my way through endowment mortgages. Oh, we have a slight technical hitch at the moment, I'm afraid. So just give us a second while we just unhitch ourselves.
I think we're okay, Adrian.
Brilliant. Okay, in that case, I will crack on again. Apologies for that, folks. If you're not hearing, then please stick something in the chat to say you're not hearing. But we think that we're okay again. So let's refire up, and let me say good afternoon to you and welcome to this Dunstan Thomas lunchtime webinar on the Consumer Duty. We'll begin with a few introductory remarks from myself as your chair today. I'm Adrian Boulding, I'm Director of Retirement Strategy here at Dunstan Thomas, and reflecting on my career, it occurred to me, that throughout my career and looking at the new Consumer Duty, my career has been peppered with a sort of fair spread of scandals resulting in fines and compensation payments. I've worked my way through endowment mortgages, personal pension mis-selling, annuities sold without medical uplifts, Equitable Life, the Woodford saga, British Steel, and probably more, all characterized by bad outcomes, probably none more so than endowment mortgages, where customers paid into for 25 years believing that they would pay off their mortgage, and in the end they often didn't. And it doesn't seem to have stopped either. Since George Osborne's pension freedoms, 3/4 of retirees use income drawdown, but with an average withdrawal rate of 8% per annum, I can see over half of those running out of money or having to drastically scale back income in later life. Annuities are no saints either, with 2/3 of pensioners living as couples. Only 1/3 of annuities are sold with a spouse's pension. That may not be a good outcome if the annuitant dies before their partner. I'm reminded of the remark that the late Queen Elizabeth II made while touring the Bank of England after the financial crisis of 2008. Why did nobody see it coming? She asked. So perhaps one of the things to come out of Her late Majesty's incredible reign as our sovereign is the concept of foreseeable harms. Anyway, I don't want to put you off your sandwiches with too many depressing thoughts, because what I do believe very firmly is that whilst FCA's new Consumer Duty is going to be an incredibly tough challenge, our industry will rise to it, and technology will help us in doing so. I once met an IFA who said all you need for managing an income drawdown portfolio is a computer and a dog. When I asked what the dog was for, he said that's to bite the client if they try to touch the computer. Now, my brilliant panel today to help me tackle Consumer Duty are Richard Denning from M&G Wealth. Richard has spent the past 20 years building and running platforms for Old Mutual, Novia, and Aegon. And at Aegon, he was integral to the completion of the Cofunds and BlackRock purchases and subsequent integrations. Since 2020, Richard has been CEO of the M&G Wealth platform, which of course you may have known previously as Eccentric. I'm also joined today by Ben Hammond from Altus Consulting. Ben has 20 years experience in platforms, including almost 15 years working for several platforms, building and launching new products and propositions, as well as navigating the complex world of regulatory change. As investment director at Altus, Ben works with a wide range of clients across the UK and worldwide, helping them develop their understanding of the investments landscape and the impact that change will have on running their businesses. And my third panelist is Joseph Grace, founder and CEO of Legado. Joseph began his career in Silicon Valley. He helped steward the growth and acceleration of some of the world's most exciting emerging tech startups. Joseph subsequently gravitated towards corporate innovation roles, helping some of the world's leading corporations improve their businesses through the application, understanding, and integration of technology. Each of my panelists will start with some introductory remarks on the Consumer Duty, and then we'll move to addressing the questions from you, our audience. You'll see that your screen has an Ask a Question button. I urge you to use it, because even if you don't want to place a question yourself, you can vote for the ones that others have put up. And as always at Dunstan Thomas webinars, we'll be giving priority to the most popular questions. You've probably noticed that Richard is having a little technical difficulty joining us. The Crowdcast software is a tricky thing to manage. So we hope that Richard will be joining us later during the show. But we will go first for introductory remarks to Ben Hammond from Altus.
Thank you, Adrian. Good afternoon, everyone. Yeah, hope Rich can join us shortly. Just a few bits from me. I think Consumer Duty is high profile. You can't get away from it. You can't go 5 minutes in this industry without mentioning the word Consumer Duty. But the thing that we're seeing, I mean, obviously you've got the April deadline, you've got the July deadline coming up over the summer. It's been a long time coming. The thing that we're finding is that there's quite a lot of focus on the value for money framework and how you prove the value for money at the moment, as well as product lifecycle management and the data and measurement. But people are really quite focused on the value for money. That's the sort of the one thing that they're focused on. A lot of our clients are interested in knowing what everyone else is doing. I mean, you get that in the industry overall, but everyone wants to know how they're doing it, what situation are they in, what stage is their data in, what technology they're using, how are we going to make this work. The regulator helpfully has said we'll know what good looks like when we see it. So everyone's thinking, well, what can that look like? How can we lean on what we've done before, our peers, and that's where we're handily coming in to help people make the best of what they're doing. There's also a lot of cultural stuff that sort of sits behind this, and that's been going on. Developing your culture or improving the culture in a lot of cases. Some of your examples you gave in your opening remarks, Adrian, about various scandals of the past and that sort of thing. You've got SMCI, you've got all that kind of stuff that's coming in the past. The culture is also a big part of it. As part of what we're doing as as a consultancy, we've done a lot of work with, say, vulnerable customers and training and assessments. So again, that's where we're seeing what customers are wanting to, so our clients are wanting to see in terms of how do we compare against others? Where do we need to make the improvements? Where should we be focusing our resource to bridge some of those gaps? If we do get a knock on the door from the regulator at some point, we've got a plan, we can tell them what we're doing, and we show how we may be fixing some of those gaps. So yeah, there's a lot of benchmarking, the value for money, and I think a lot of that is underpinned by not just working out where your data is, where it sits, how you're going to make best use of it to prove some of that, but also around the digitalization of the product offering and how you do that as well. So it is about making sure you develop the right products for the right people in the right way and distribute them in the right way, all that good stuff, which we've been doing for many years, doing it in various bits of regulation such as RDR. But there is a real drive for, I suppose it is, making sure that all clients are catered for in the right way with the right products. So a lot of the digitalization, a lot of robo, hybrid, augmented, whatever type of advice you want to call it, but all that, bridging the advice gap, simplified advice, everything like that, it is all encompassing. So I suppose in summary, Consumer Duty just kind of touches absolutely everything that we're all doing in all aspects, and that's not just platforms, but across the whole of investments, and going back into back book pensions that are sitting on an old system over there that we don't know how we're going to deal with it. All of a sudden you're going to have to deal with it and prove how you're doing proving value for money for those customers, how you're going to deal with them in the future. So it's a big thing. There's lots to do. I think generally firms are getting a good handle on it, but I do worry when you see some of the headlines about only 40% of advisor firms have worked out what they're going to do, and we've only got 3 or 4 months to go. So going well, but still a lot of work to do, I think would be my summary.
Well, I think that's a brilliant summary. I think we're all feeling that we're going flat out trying to achieve it. There's a little way to go before the start date, but boy, there's still quite a lot to do. Joseph, that's quite a nice sort of way, I think, to pass across to you for your introductory thoughts about Consumer Duty.
Absolutely. Thanks, Adrian. Thanks, Ben, and thanks to the whole Dunstan Thomas team for hosting me and ourselves and creating the session. I'm going to look really forward to the chat we're having today. So we're coming at it from a slightly different perspective, from a technology perspective. So what I'm going to do is tell you a little bit about Legado and our platform, a little bit about what we do, and then a bit of background on the company. And then as we come more into the conversation around Consumer Duty, I'll be talking about it from a technology perspective. My name is Joseph Grace. I'm the founder and CEO of a technology business called Legado. And really the two cross-cutting rules within Consumer Duty, acting in good faith toward customers and avoiding causing foreseeable harm, are two tenets of why we started Legado. Legado has developed a data as a service platform, and it's focused on eliminating the fragmentation of personal data and files across enterprises, communication of documents to customers, items like statements, policies, marketing materials, improving ownership of data by consumers, and finally, streamlining corporate processes. Things like account opening, change of address, change of provider, bereavement, divorce, marriage, life events. That is what Legado can help with. The Legado platform, it has 6 core modules. We have a communication module, which helps organizations with secure correspondence and interaction with customers. We have a digital vault module, which helps customers to plan for key life events, all the way through from leaving home at 18, through to planning retirement, through planning for the end of life. That's why we created Legado. We have a connectivity module, which helps with the more day-to-day life management, things like bill and household affairs, and helping organizations and their customers to connect to third parties outside of just financial services. So with companies in utilities, entertainment, health, and more. We have an insight module, which we've been really focused on creating over the last 18 months, which helps to provide personalized nudges on customers. And finally, we have a workflow module, which is really focused on helping to digitize those areas that have often been forgotten about or neglected, which are quite manual and have quite repetitive processes. So hopefully you can see all of these different modules have a number of different features to help organizations to comply with the various aspects of Consumer Duty. To give you an example, delivery confirmation of communications, to a comprehensive Consumer Duty dashboard, which aligns a customer profile and each of the different attributes of a customer's profile to a certain product or service which is being offered by a regulated organization. In terms of our platform, it's all built on very modern technology. We are a cloud-native company. We use AES 256 encryption technology, but we're also very flexible. So we understand different organizations have different requirements, and we can be very flexible as to how that technology stack is deployed. In terms of the background on our company, I'll just give you a little bit of background. We have 2 strategic institutional partnerships, one with M&G and one with the FNZ Group. The company is 5 years old, as Adrian outlined, and we have 30 employees headquartered here in Edinburgh in Scotland. And we genuinely believe Consumer Duty will have a massive, significant transformational impact on financial services, and we're looking forward to helping organizations with their ongoing journey of compliance and creating better outcomes for consumers. So thank you, and looking forward to the conversation. And hi, Rich. Good to see you.
Hi, Joe. Sorry, I'm late and Adrian, you're muted.
That's better. Rich, thank you very much. I'm delighted that you made it through all the software, sort of log jams and the rest of it. So welcome to the seminar. We've done introductory remarks. You knew we were going to do that because we had a rehearsal before.
I did.
But we weren't able to let you go first on the introductory, which was a bit sad, but there we go. But it's your now. So, a few remarks from yourself, please, on the new Consumer Duty.
Yeah, Hi, everybody. I was going to say morning, but obviously it's lunchtime. So second time on screen in a week. I'm making a habit of it. I'm going to try not to get myself into hot water, but I don't do very well at that, as a lot of you that are on here that know me know. Sort of thinking it's consumer duty. I mean, I think what's interesting, Adrian, I think we discussed briefly the other day, is actually when this came out, it kind of hit a few headlines and people sort of talked about it. And the general kind of view at the time, I think, was, well, we do this already. So this isn't a big deal. We're already providing fair value. Of course, we can evidence fair value. Of course, we know what our outcomes are for our customers. We've got a vulnerability policy. I know that Altus guys have done an awful lot of work on vulnerability over the years. It's fascinating now sitting here as we nudge towards April, the realization that actually what we thought when the duty was first published and first came about is the reality is it is significant. It's actually huge, probably in the long term. It isn't TCF, it isn't MiFID, it isn't RDR, it isn't. You get to it, you change a bunch of literature, and you go, look at this. We've got a 10% drop solution on MiFID. It's much higher than that. The things about evidence. Actually, it proves harder when you get into the duty. It proves harder than you think it would initially to actually produce evidence and solid evidence. There's a high bar actually on boards, and there's a lot of oversight from boards and Dear CEO letters and reminders from in those Dear CEO letters that your board needs to be engaged and you need a board champion. There's a whole kind of bunch of interesting stuff emerging in the advisor market this week. Since we last spoke, the first time I've heard advisors talking about platforms and selecting platforms in respect of foreseeable harms. And that was it actually in and around bank interest and cash treatment. And if that's excessive, is that a foreseeable harm or not? I honestly don't know. I mean, that's something that we'll have to you have to work through with fair value. But I think my observation, obviously the duty's here to stay. I look at July as phase one of that. I think as that beds in and as the regulator allows some time for that to bed in, we'll see more things coming. We'll see more alignment. We'll see more software solutions. That's not been actually that surprised me as well. There's not been that many kind of software solutions, say in the kind of data space in and around price and value that I would have expected to have seen. They're coming, and I think the asset management world's perhaps a bit further forward. But that's my take as we sit here now at the end of March. I mean, we'll speak selfishly. We're in a good place. We've got some stuff that we've got to publish for April, which we'll do. We've got some things that we need to do in terms of websites and literature, but we know what we need to do. But that's the thing for me. This is here to stay, and it is big, and it's much more profound than I think any of us realised when the duty was first published. Certainly more than I realised.
Great, thank you, Rich. I think you're right. It's big. So we're going to go to questions. The questions are starting to come in. I encourage you to, sort of pop some questions up, please. And as always at Dr. Thomas webinars, we will be, voting on the questions. So our top billing question at the moment, with 4 votes for it, is asking us: is consumer duty a threat or an opportunity for providers and/or platforms? Who would care to have a go at that? Ben, that's really right up your way in terms of consulting. If you had a platform or a provider come to you, is this an opportunity or a threat for them, and why would you say that?
I'm going to say I think every bit of regulatory change is an opportunity. It just depends how you see it. So I think we'd always say that, whether it's an RDR or consumer duty or MiFID or any of those other examples, there's always something that a provider or platform or advisor, whoever it is, can do above and beyond the bare minimum. So don't see it as a threat. That's the thing. These things, it's going to happen. You're going to have to deal with it. You're going to have to meet the regulatory demands, speak to the FCA when they turn up, or whatever it is. What can you do to then benefit your customers, benefit the advisors, and make the best of what's being, some people say this stuff's being forced on you, but what can you do to make the best of it? So I'd absolutely see it as an opportunity. Why do I see it as an opportunity? I think it is whether you're a product, if you're a product provider, it's an opportunity to be really clear about who your customer base is, who you're aiming your products at, looking at opportunities to bring in the efficiencies, digitalize if you've not already, even jettison some of the old stuff or outsource or whatever it is. There's lots of different options, but I think it will focus everyone on looking at what those options are and almost force the hand a bit, because you've got to make some changes, or at least do the assessment and then probably make some changes off the back of it in order to prove the value for money, or whatever it might be. And I think much is the same for platforms. So, I've seen a lot of conversations with maybe platforms saying, "Oh, bloody hell, we haven't got annuities." One of them might have been with you, Rich. We haven't got annuity on our platform, or access to an annuity. We thought we were going to have them. Then they all went away, in inverted commas, because of pension freedoms. All of a sudden, we used to get 10 applications and we could deal with them on paper in a month. We're getting thousands through the door now because of annuity rates. What are we going to do about that? In fairness, this is a lot of the life codes who've also got platforms, and they're trying to work out, well, how do we blend the two together and get our own products onto our own platforms? Because sometimes it's not always completely linked up. But again, it's going to be an opportunity to develop those products, become more efficient, digitalize if you've not already, and really look at how you can service your entire customer bank, including things like simplified advice, which we know is coming as well. So definitely an opportunity.
Lovely. Joseph, can I come to you and ask, how would you use technology to try and sort of, crystallize that opportunity and make the most of it?
Yeah, absolutely. I mean, well, first of all, we absolutely see it as an opportunity, of course, from both the provider and the platform perspective. We see Consumer Duty as really accelerating the adoption of technology. The way in which we've created Legado as a data as a service offering is really all about maximizing the value of the current data that exists. So that's both in terms of the customer to which you're providing a product or a service to, understanding them better, understanding which products and services are applicable for them, and creating a model that an organization, a regulated organization, can use and apply, and then see if a product or service is applicable for a certain customer. And likewise, that's an ongoing model. So as a customer circumstances change as they progress through certain life stages, from being quite young, perhaps not having a lot of wealth, having a lot of experience. There's clearly a very different product and service set that's applicable from them than someone who's reaching retirement or is at retirement. And organizations need to be aware of this, need to be aware of the different individuals' needs and circumstances, and be presented that in a way that's quite intuitive and quite easy to understand, and not fragmented as in some cases today it currently is.
Rich, if I could come to you, you're running a platform. Have you appointed a Consumer Duty champion yet? And how do you see this as an opportunity?
Well, Consumer Duty champion for us is one of our non-exec directors, a lady called Marican Tenement. And on the kind of, other than me, on the day-to-day basis, it's our customer service director, Adrian Heather Curtis. I kind of err more towards Ben. I think in Ben's response. Nice curtains still, Ben, by the way. Brilliant background of the week. I think there's more opportunity in Consumer Duty than there is threat and challenge for product providers and platforms alike. I mean, it's early. I mean, that's the thing. It's early to say. And I think, but it comes with some challenges. I mean, to give you a specific example, we've a previous government that said it was okay to have pension freedoms and buying Lamborghinis and all that good stuff. And then you look at even existing regulations, actually, but look at Consumer Duty and look at a customer who's given a platform 100 grand, taking 25 grand in tax-free cash, and is drawing down the remainder of their pension at quite what you'd say an aggressive rate. That's fine from a platform perspective as things currently stand, because that's actually allowed and it's all perfectly permitted. And if that's what the customer wants to do. The question under Consumer Duty, is that a foreseeable harm? If as a platform we knew that was all the customer had and they were going to run out of money, and the problem is, of course, we don't. So, the requirement around meeting the customer's expectations and needs, we don't know what those expectations and needs are because we didn't give the advice in the first place. So, we've got some challenges with our advisors to work that type of thing through, because the last thing that you would want to do as an advice platform or a provider is write to an intermediated customer and say, you're taking your pension too fast. It's going to generate a lot of complaint from, and that's not what we're intending to do, but there's quite a lot of that as we kind of work these things through. It's certainly around foreseeable harms. I think value will be a little bit more subjective, and there's actually perhaps more data in the value space as well, and that'll kind of calm and settle down, and we'll have benchmarks and so forth. But it's the kind of thing in and around foreseeable harms, and how far that goes, and you could extend that even into an asset. So if we put hit the headlines again today, Woodford, if you put an offshore investment trust with an average share price of £1,500 and let someone with £100 a month ISA subscription into it, is that a good outcome? Is there potentially foreseeable harm? So I think it's right now it's probably a score draw. I think the duty overall is good, but in terms of what it does in terms of opportunity and threats, too early to say for me. But I'm probably more inclined towards Ben that in the long term it will be more of an opportunity.
I think we'll see some quite sort of subtle changes of behaviour as we go along. I made my own sort of final end of tax year pension contribution earlier in the week. Whereas in past years, the platform, I won't embarrass them by saying which platform it was on, the platform has just happily sort of gobbled it up and said, thank you, Adrian, got your money. This time they said, oh, Adrian, are you sure you want to pay that? Have you kept back enough money for your immediate needs and stuff? It was all very softly done. But I thought, oh, yep, that's just stopped me to take a little rain check, and I had to tick the box and say, yes, I got enough money for my immediate needs. And then I could, press on. So it wasn't brusque, it wasn't interfering, it wasn't stopping me doing what I wanted to do, but it was just edging me back a little bit and, make me think. If I press on to our next sort of top voting question, it's around the popular topic of vulnerable customers. Of course, vulnerable customers are particularly susceptible to bad outcomes, and increasingly as we become aware of people's vulnerabilities and the need to check for those, maybe those harms are a bit more foreseeable than they used to be in the past. So we're going to address this question: what's the emerging best practice in supporting vulnerable customers, and does Consumer Duty change anything as regards this? Ben, can I go to you first again?
Yeah, sure. In terms of examples, so what we're seeing, as I mentioned at the top, we've got a tool and a benchmark tool that we originally launched with TISA actually 4 or 5 years ago, and then we've used that as benchmarking, etc., as we've gone through. I think how we'd see Consumer Duty is that vulnerable customers is now, I'm going to call it a part of Consumer Duty, but what I'm saying is, it's taking that and really building a lot of other stuff around it. So there's some other core principles that have kind of been built around that. But if you've done the Consumer Duty assessment and made a suitable number of changes, and you take TCF and RDR and all those other things that I think you and others have mentioned, Adrian, and bring it all together, you should hopefully be, no matter who you are, and platform, asset manager, advisor, whatever, in a reasonably good position to be doing that. There's a lot of regulatory and just good practice and good ethical practice that's been around for a long time that will help you build that. But there are then some specific rules or tenets or whatever it might be, bits of guidance. So, for example, one particular one that we get asked about is, okay, good customer outcomes, value for money, that's all good, be they a vulnerable customer or not, but actually you've got to prove that it's not an accident. So, it's not just, it happens to have been the right thing for that customer, so you putting your money into your pension or whatever it is, Adrian, but you have gone through the process and maybe made them stop and think and just double check that it is actually the right thing to do, rather than it just being a bit of luck at the end type thing. So I think a lot of it is around the control. What we found when we were doing a lot of the vulnerable customer work again over the last few years is that some people go, oh yeah, we're just going to have a tick box, are you a vulnerable customer? And in the D2C platform we'll tick that, and that's like that's really bad, but it's probably better than absolutely nothing, but it's still not the right thing to be doing. You've got to go through the assessment and what have you. So I think it's it's just a big part of Consumer Duty, and I think we see it as building on what's already been done, and increasing the amount of good practice, and actually but putting a bigger wraparound wrap around it to encourage even better behaviours, and then putting some strict deadlines on it as well, which is the other big thing.
Yeah.
Thank you, Ben. Rich, if I could go to you, how are you ramping things up for where you deal with vulnerable customers?
Well, we've had a vulnerable customer program running for a long while. So there's a level of maturity. I think what's been interesting over the last while is the number of customers that the FCA would say are financially vulnerable now. So whether that's because they've got low resilience, because of everything that's going on with the cost of living crisis, or actually just because it's people that just don't understand. And so as vulnerabilities maturing and as the definitions get clearer, actually the bar again for dealing with vulnerable customers is actually higher as well. So we have, as Ben, Ben and I haven't even exchanged notes, but the vulnerable customer work we have just sits alongside and is integral to Consumer Duty now, and it will be going forward. You can't do them separately; that just wouldn't make any sense. But definitely, as we kind of move forward, we're gonna. It's a little bit similar to the kind of Woodford example. We're going to have to, as providers and as platforms, do more, certainly in relation to customers' financial vulnerabilities, but without a shadow of a doubt.
Yeah. Joseph, I wonder, is there anything we can read across from some of the wider fields that you've been working in for, how to best deal with vulnerable customers?
Yeah, I mean, I think the second part of the question, really regarding how Consumer Duty will change this, I think I completely agree with Ben. As opposed to it being a kind of one-off checkbox exercise, Consumer Duty, as it continues to evolve, will make this far more of an ongoing assessment of a customer. A customer that bought a product or a service, whilst initially may not have been vulnerable, may become vulnerable as time goes on. And I think technology will play a huge role in enabling organizations to actually get this ongoing assessment of a customer, whether they're vulnerable whilst they're buying a product or service, or whether they've become vulnerable as they've aged or gotten older. And then in terms of technology, not only being able to enable that ongoing assessment, I think it can also enable the ability to better speak to them through personalization to certain customers, videos and user journeys, and that might be through specific product customization, so making products accessible, really cutting through a lot of jargon and huge 50-page booklets of text, presenting plain English in terms of products, and just keeping it very simple and making it accessible.
Brilliant, thank you. Now we've got a super question that's come in from Steve Mitchell, which is about not what do we need to do, but how are we going to do it? And Steve specifically looking at the sort of for money. Do we think that we're going to see greater usage of assessment of value reports, or do we think the value for money fields in the new MiFID template are going to be the ones that are more commonly used? So, which of these is the VHS, and which of these is the Betamax? Rich, can I come to you first on that one?
Well, that's a classically brilliant question from Stephen, and I suspect that Stephen's business have probably doing some. In fact, I know they're doing work in this space. I actually think for us as a platform, we couldn't just rely on the MiFID data. I think that's what I was saying earlier about the asset management world being slightly ahead in that, is because actually you probably can more. So obviously M&G, we've got a big asset manager and the work they're doing in that space. But I think from certainly for platforms, I think what I see being done in the market is relatively rudimentary for July, and I think it will have to build out. So because it will be about the overall assets, it will be about the price of the wrapper charges, transaction fees, and I think obviously Dunstan Thomas, you've got the Imago illustration engine. That's going to be interesting to see whether there are any kind of disclosure changes and requirements, whether the illustration forms part of that. As a whole, I think for now, what we're doing is all right, but again, I come back to the duties here to stay. I think over time it will evolve, and I think if I was sitting running a software business like Joe or Equisoft that are now proud owners of Altus, or you guys, I think I would see that, or even FE where Stephen is, I'd see it as a big opportunity to get some products out into the market. There's a lot of very smart people in this business that probably could do it, but actually I think these things should be utilities at the heart, and there should be almost whole of market solutions. So I look forward to having a chat, Stephen, and fleshing that one out.
Lovely, thanks. Ben, can I ask you a quick comment on that one? Assessment reports versus MiFID reports.
I think for the consumer, if you start saying MiFID to a consumer, they're not gonna know what it is. So I think it's got to be based on what they're going to get, and I'm going to say some nice graphics, but a digital outcome, also a digital output that a consumer can easily see. What have I put in? Does it, what am I going to get out? How is it growing or not? Is it going to meet my goals? All that sort of stuff. They're going to want something simple, really, and then it will be. I mean, if you're an asset manager, there's a whole another set of rules around that. But along with the growth, is it meeting the benchmark? Is it how does it compare in charges? All that kind of stuff is all going to be behind it. What the consumer, the end client, is going to need is just an easy way to look at that. And then it's if they're an advised client, it's going to be up to the advisor to take them through that and kind of prove their own value as well, I suppose, as part of that. For a D2C platform, it'll be a little bit harder, but actually at the same time, if you get that journey right and you get that customer engagement right, I think it should be quite an easy thing to do. But I'd also go back to my previous point around it needs to be proved that you've got a good outcome and you've got good value for money, not just the market shot up and you've got a good outcome and you doubled the size of your assets over 5 years to meet your goal, and it was a bit of an accident or it just happened to happen. How we actually work through that, and how can you actually prove that overall value for money?
That's great. I'm going to skip on to the next one because I want to throw the next one at you, Joseph. And our next question's coming from Andrew Martin, and Andrew's asking, are we going to see a race to the bottom on costs or a race to the top in terms of value add? And we know that consumers always like to have something cheaper than they had it before, but can we create technology and service and product offerings that are attractive enough that will make consumers look at value rather than costs?
Absolutely, and I think with technology, you actually have the opportunity to do both. That's one of the beauties of technology, taking costs out of a business, bringing down service charges, bringing down ongoing charges, whilst also being able to improve that customer experience and offer additional value-added services. So I think it's actually a blend of the two. I think we can achieve both. I think as we've seen quite a lot, I think there will be a lot of focus on cost. But I absolutely think technology solutions, and as Consumer Duty continues to evolve, you will see there is a blend of both value-add solutions coming out as well as costs being taken out of businesses.
Super, thank you. And Rich, can I ask you where do you position M&G Wealth in terms of sort of value and cost?
Oh, bless it. It's interesting. I did an interview, as I said, I think earlier last week with Citywire. It's interesting people's perceptions of a business like M&G and the reality of working inside a business. There's a perception that we sit and talk about vertical integration and go, right, rub our hands and go, how much money can we make and how much could we put this up? And it's not the case. Each part of M&G Wealth looks at fair value already. So if you're Shanti Kellerman running the investment business, the model portfolios sit on other platforms, they have to be fair value. We compete in a platform market that's very competitive on price, and we have to provide value and value of service. The advisors that we've got, Sandringham, Continuum, they compete in an advice market where if their fees are too high. So it's not that we pull it all together and try and do it something. It's not like that. Our asset managers competing against Janus Henderson and a whole bunch of other people. I guess with PruFund is what it is. There isn't really a competitor with profit smooth solution out in the market. But I mean, I'm going to say it. I think we provide fair value in the round, but we under Consumer Duty, we definitely are pulling all of that together because we have to, right? There has to be a view that David Montgomery's level, but actually on the ground, because of the markets we're in and because of the propositions we got, because of the current COBS rules regulations that we operate under anyway, each of us have got that run the businesses that form M&G Wealth have got to do that. So it isn't as contrived as I think the external perception would have you believe.
Thanks. Ben, I want to come to you with the next question that Miles has sent in, and try and use your breadth looking across the whole sort of spectrum of investment providers. Miles asked, what might a value for money calculator look like, and what are the key parameters that we're going to need to be sort of putting into it?
That's a good question. Let me have a think about that one. It's hard to say what it could actually look like. If you're talking about what could you put in front of a client, then I don't think that's, in all honesty, I don't think that's possible. I think it is more about the longer term outcomes than what I said in the previous comments. But it's just so many factors about how you actually measure that. So you're talking about parameters. I think parameters of value. It might be underlying cost and how it compares to other funds or products or whatever it might be in across other platforms or other similar if they're benchmarked against particular indices, how is the charging that sits behind that. So there's been a lot of conversation in the asset management world about 1% tracker funds and things like that. I think some of that's been done to death, some of it is still around, but there's that sort of pure, well, hang on a minute, that just seems very expensive for what I'm getting. Is that fair value for money? Probably not. What do we need to do about it? So it could be that simple. It could be a little bit more sort of buried in the data, if that makes sense. And you do need to let an investment or a product, a long-term pension, you're going to keep your pension for 20, 30, 40, plus years. You need to let it play out because there will be a lot of variances over time. So in a short-term period, it might look like that's not very good value for money, but actually over time, it is actually proving that good value for money. So I think it is about being clear what the aims of the client are, what the products and the services are that sit behind it, looking at the overall value, but then not always that cheapest is best. You can say that about any industry, that cheapest is not always best. Probably not best because you tend to pay for what you get for. But then being able to measure that throughout and actually at the end of the term or at a period or after 5 years or whatever, being able to say, here's what you wanted, here's where you've got to. And as part of that assessment, do we think that is providing you as a client with ultimate value for money? So I don't think you can have something that's a calculator that people can put stuff into. It is much more complex than that.
Yeah. Joseph, I know it's complex, but how would we use technology to sort of tackle some of this? We can do the costs bit easily. We just run up a little Excel spreadsheet and you see how the costs are doing. But some of those softer factors, how can we sort of get those into a value for money calculator engine?
Yeah, absolutely, and it is a really good question because you look at some of the value for money tools and solutions today, and they're built to be quite generic. You put in certain values or attributes, you get out an answer. It's not personalized to the individual, and I think over the years, as we'll see, what will take place is these value for money calculators will become far more complex and far more intelligent. The attributes that are put in will be based on an individual life stage, financial well-being, financial health, and other attributes that are individualized. That then gives a very individualized response on whether or not a certain product or service is actually value for money. Now, how do you get those attributes, you ask? Well, I think they come from a variety of different sources. I don't think there's a single source of an attribute. I think you need multiple different sources on an individual, whether that's sources like financial health through open banking, whether that's sources like bills, for example, the different bills you have in an individual's household, which is something that Legado does, utility bills and your entertainment bills, your health, things like that, where you can actually process those types of documents and really get a far more rounded picture on an individual, which you can then put into a value for money calculator and get an incredibly personalized response on whether or not a product or a service is actually value for money. And that will only continue to develop and get more and more and more accurate as technology evolves and evolves as a result of consumer duty.
That's great. Let's roll it on because we got 12 minutes left and we got some more questions here to do. I'm going to break our normal habit and go to the question at the bottom of the page instead, because I think it's a really super question. It's coming from Scott Greenway. You're probably a terribly unpopular guy asking this, Scott, because I'm the only person that's voted for you, but I think it's a really important question. We've talked about the fact that providers and platforms are going to need to know rather more about customers than they have historically. They're going to have to start asking some questions and interacting more with IFA's clients. So Scott's question is, will platforms use the Consumer Duty as a cause to market to IFA clients with their D2C versions?
Absolutely not. I mean, I can't imagine why anybody, I mean, certainly I'll talk for M&G, absolutely not. Not even sure you can, actually. I mean, there's the marketing communications and consent requirements are pretty tight, right, anyway. But no, I say that I don't talk on behalf of the whole platform industry. There may be some, bearing in mind they keep being told I work in a legacy business now. And the kind of for the legacy providers wouldn't do it. Maybe the more nimble, agile, new entrants to the market might have a go. But you'd be a brave person to try and talk to a client who was intermediated, had an active relationship with an advisor, and think you'd come off on the right side of that conversation. But it's you're right to go there, Adrian. It's an absolutely brilliant question.
Rich, that was some strong, reassurance for IFAs. But Ben, can I come to you on that? Do you think there's a danger of platforms and providers wanted to come in and disintermediate?
I would absolutely hope not. So I agree, Rich. To do it would be, shooting yourself in the foot or whatever you want to, however you want to sort of term it. There's been other examples of where this has happened, not consumer, but this has been happening for years. And there's always that debate between, the platform saying, well, it's, this customer's not had any contact for 2 years, the advisor's gone away, or whatever's happened, we feel like we've got to step in. That probably does need to happen at some point in order to make sure that they are, ticking the right boxes and the regulator can't come and have a go at them. But at the same time, it's about if the platform thinks that is the case for whatever reason, don't just jump at it. Go and talk to the advisor and make sure it's in, you're doing the right thing. So I would absolutely hope not. But at the same time, there is a lot of discussion around, orphan clients. That's been around since RDR. But what do we do if the client on our platform sacks off their advisor? We've got to have a proposition or a way of dealing with them, or X months to move, or whatever it might be. So we need something there, but we shouldn't enact that until we've gone through the right steps and certainly not being stepping in and using it as a reason to grab more direct customers. That's just plain wrong. And in fact, it's probably against Consumer Duty if you think about it like that. So they'd be breaking their own rules by doing it.
Yeah, brilliant, lovely. Thank you. We're going to come back to vulnerable customers again, because that's proving quite a important train of thought. I got 2 questions we can kind of take together here, I think. One's coming from Stuart Please in terms of where do we see the key issues in understanding vulnerable customers across touch points and platforms, but also a question that's coming from Andrew Gething, which is worth addressing at the same time, I think. And Andrew says we got 50% of customers potentially vulnerable. Firms need to understand vulnerability at an individual and firm level. And how in practice will we assess and understand the vulnerabilities for customers within platforms? Rich, can I come back to you again on vulnerable customers?
Yeah, I think so. I think we touched on some of it earlier, and I think it's hard, right? Because it's where do you get the data from? So, so customer gets made redundant, and they struggle financially, and they become financially vulnerable. How do we know that? Where do we get that data from? We're entitled to get that data. We do already, all platforms, banks, building site, financial services probably use a solution like Experian on money in and money out, just to check the customers, because fraudsters do it for a living. They're sophisticated, try and steal money. So we already have got access to a lot of information. We can't use most of it, actually. So there's going to be, I think, again, as the duty starts to emerge and starts to go forward, we're going to have to work with the regulator and work some of these scenarios through in terms of if we have access to that kind of data or made aware of that, what can we do with it? What are we allowed to do with it? What's reasonable? What would the customer expect us? Well, that's the most important thing. Would the customer expect us to know they've been made redundant and now financially vulnerable? They're falling behind on their bills. Their credit score's gone down from 1,000 to 200. And I think it's that needs to be. It's definitely here to stay, and it's definitely things that, as an industry, we need to do more on. And I think that's a particularly acute problem for the D2C businesses that have more typically a lower value pot. I mean, there's platforms in the market whose average customer size is £5,500. So getting into it's going to be, I think it plays to Joe and Joe's business, actually, because Joe's business is like a lot of software business. It's ultimately a big data business, collects and consumes a lot of data, and it's how we can get that data and use it to help the vulnerabilities, and to the earlier point, not to use it as a means by which to market people and say, look what we've got this wonderful protection product for you. So I think it's going to be work with the regulator, look at the data, and then work out how we engage through the intermediary with the intermediary, or if the customer's non-advised, how we deal with the non-advised customers.
Joe, Rich has really thrown up a challenge there and underlined, I think, the sort of breadth of spectrum of our marketplace. So at one end, we can have an IFA that goes in to see his client face-to-face regularly, will be well aware if the level of vulnerability is changing or if they're starting to become a vulnerable customer. At the other end, as Rich said, we've got platforms that have got, a £5,000 customer. How can we use the technology to help us sort of deal with that end?
Yeah, absolutely. And I completely agree with everything Rich has said. The most important piece is how do we get the data? How do we get the data on the individual client? And I think first and foremost, the absolutely primary way to do that is work with intermediaries. Work with intermediaries to actually create that engagement point with a client to understand their profile better and offer technology that works for intermediaries to collect that data that allows you to actually create an opening point and begin to collect more data on that individual to be able to get a better insight into their profile. At the other end, those kind of smaller pots, I think it's all about creating tools around certain engagement points within a client's life. And, clearly a retirement tool or a midlife MOT tool isn't that appealing to someone in their 20s or their 30s. And similarly, a first home guide or having your first child type of guide isn't that appealing to someone maybe in their 70s or their 80s. So I think it's around creating really life event focused tools that give you opportunities to get engagement at certain life events. And at which point, when you have the client engaged, you're able to actually consume more data on them to understand them better, to offer more personalized services and around whether or not they're vulnerable and in general.
Thanks, Joseph. I want to go to our next top question. This one's coming from Johnson Thomas head office. It's one of those, nightmare moments that you got an email from head office, and it's just from Johnson Thomas, but I got to answer it. And it's on that vexed issue of customer engagement, because we're trying to avoid foreseeable harms. We're trying to guide the customers through to do the right thing, trying to get them round the bear pits, not falling into them. But it wouldn't half be easier to do this if the customers didn't actually engage a bit, and realize what they were doing themselves. So we are going to need some higher customer engagement to work our way properly through consumer duty. And we're being asked what's the best way of increasing customer engagement rapidly. Who's got some ideas on that, please?
I'm very happy to open with that, because this is a question that genuinely excites me, because for me, it goes beyond financial services. It's what engages anyone in life, and it's things that interest them. And so you have to build propositions, digital propositions, for me, because I'm speaking from a technology perspective, that personally engage an individual. And if you can do that, then you'll have the person engaged, and then you can begin to drip other information, other guidance, other information toward them, and equally they will drip data back to you to be able to personalize products and services. Very whistle-stop answer there.
Lovely.
Yeah.
Now we're running tight on time, so I'm going to jump to another question down the page, which is really exciting. It's coming from Richard Stanton. It's about AI. Given the current hot topic, how much will AI become relied upon to meet and maintain consumer duty requirements, and how close is this to actually becoming reality? Ben, can I ask you for some thoughts on whether we can use AI at all here?
Depends what you mean by AI, I suppose. That's a bit of an open question. You know, referring all your customers to ChatGPT probably isn't the best way to go. But I think there is, yeah. So if you're thinking about, you know, sort of guidance and ways of taking customer through a journey, and some of the digitalization stuff that Joseph was talking about just there, and I think it's about removing the blockers. So if you can remove that by some intelligent systems, whether that's AI or just being able to digitalize things, then that can only be a good thing. And that's not just in financial services; it's all over the place. But you know, we've seen a lot of web chat, video chat, other online channels just not being on hold for ages, but just being able to get access to the information in a variety of ways when you need it. That's what you need to unblock things. You're never going to cater to every single need. There's always going to be some blockers, and you know, no firm's perfect, nobody's perfect. But at the same time, having that variety, looking at who your customers are, and actually, you know, serving them as best you can. That's all that we can do. But doing the research, gathering the data, and everything else, AI could come into it. I think, but it depends what you mean by AI. Get it out. Yeah.
Rich, can I ask which way you land on that? Ben says AI could come into it. Rich, where do you land on that?
I don't know. I think I'm getting to that age, Adrian, where that type of thing it excites Joe and frightens me. The data and the use of data and computing, IBM Watson, Google Mine, ChatGPT, it's here to stay. We're all just going to have to work out, and we have to live with it and work out. Use cases in financial services. I don't think financial services have done a particularly brilliant job. You know, do you really want to ask Alexa the value of your pension on a daily basis like you would the weather? Not really, but there'll be some use cases from this tech for sure.
Joe, can I come to you for a final comment? AI, how can we use that to help us with consumer duty?
Absolutely. I mean, I think as has been a bit of a reoccurring theme throughout today's webinar, I think consumer duty will continue to evolve, as will technology in line with that. So immediately, I think we will have to explore how AI can benefit. I think in time it will become clear that AI can absolutely benefit through some of these outcomes for vulnerable customers, through making things easier, more personalized, more digital, introducing simplicity into both the customer, the client experience, as well as the advisor experience. So I absolutely think it will help, and it will make things and life easier for all stakeholders involved.
Lovely. Well, we're out of time, folks. So it's up for me now to, wrap up to what I think has been a great run around the issues raised by the new consumer duty. You may have noticed that my colleague Alex has put up a banner at the bottom of the page with a link to the white paper on consumer duty that Dodson Thomas has published, and you're very welcome to download that if you're still hungry for some more on consumer duty. But for now, it's my final duty to thank our three panelists, Rich Denning of M&G, Ben Hammond of Altus, and Joseph Grace of Legardo, for sharing their thoughts with us. I feel the richer, all the more richer for it. And to thank you, as our audience, for giving up your lunch hour to come and be with us. Thank you very much, and have a good afternoon.
Thanks, everyone.
Thank you, everyone.